Soumya, good morning. Tavleen, good morning. Ashwini, Balaji, Chetan, Komal, Archana, Parul. Good morning. Good morning. Love to have you here. And when you log in on time, I'm really excited. Good morning, Priyanka. Komal, good morning. Komal, the sweetie girl. Okay, so now time to start. Priyanka, Kalyan Sundaram. Good morning. Good morning, all. So friends, last time we were discussing about the topic in relation to dividend, and I'll continue with that topic only so that it is much easier for us to link. Okay, so I go ahead. If you have any questions, you can certainly ask me. Any queries if you have, or you want to ask any question, or I go ahead. So I presume there is nothing. So the last time we had started with the topic of dividend, and there I discussed about what is called a dividend and why it is called a dividend, where from you can pay. Now, some more provisions we will take up today, and thereafter, whatever is left out, whatever time is remaining with us, we'll complete as much as possible. And later on, we can talk about how the balance portion can be done. So declaration of dividend, this is no dividend shall be declared or paid by a company in any financial year except the sources of declaration of dividend are given that where from you can pay dividend. So that I had already discussed that you can pay dividend out of profit. Profit for the purpose of company law means net profit out of after taxes. So net profit is a different term. So net profit under Companies Act carries another meaning, and net profit in financial terms carries another meaning. So as far as company law is concerned, net profit is equal to net profit that is available for distribution, right? So how this is distributed, whether you transfer that to reserves or you pay that by way of dividend or you do something else, that is up to you. But profit is certainly after taxes for the purpose of company. Net profit carries a altogether different meaning, and that is for very, very limited purpose, say political contribution or managerial remuneration. So those are the purposes where the term net profit is used, and for a very, very limited purpose. So dividend is not out of net profit, dividend is payable out of profits of the financial year for which dividend is to be paid. Dividend can be paid out of the profit of current financial year, but for current financial year only, not for preceding financial year. You can also pay dividend out of the amount of the profit which has not been transferred to reserves, as well as you can also pay profit out of the reserves. So any profit which has profit of the preceding years which has not been transferred to reserve, that is also available for distribution by way of dividend. Just 1 minute, please. So the power plug is not locked in. So the power is here. So these are the sources wherefrom you can pay dividends. So first is profit of the year for which dividend is to be paid. Number two, accumulated profit not transferred to reserves. Number three, free reserves. I explained you meaning of the free reserves. Then profit of the current financial year. But profit of the current financial year can be utilized to pay dividend for current financial year only, and that you can say interim dividend. Profit of the current financial year cannot be utilized to pay dividend for the preceding financial year. Right? Then something more is said that money can also be paid, number B, out of the money provided by the government. This is something which you will never see practically, because this concept was stopped in the 70s. But before that, certain government companies made public issues where the government had given a guarantee for dividend every year. So even if those companies are not functional today, but legally those companies are existing, shareholders are entitled for dividend and the money is provided by the government because the guarantee was provided by government. That's why. Let's move further. Yes, subsection 2. This is for the purposes of clause A of subsection 1, depreciation shall be provided. There is no option left as of now whether you will provide depreciation or not. You can provide it at a lesser rate or you can provide it at a higher rate. As of now, there is no option. In previous company law, that is Companies Act 1956, there was a provision where with the prior approval of the government, the dividend could be declared without providing for depreciation or by providing depreciation at a lower rate, but not now, not in new law. The depreciation has to be provided at the rate given therein. So there is some queries. Let me see what the query is. If profit of the current year is not sufficient, we can take profit of the previous year for declaration of dividend. For paying the interim dividend, if you want to utilize the free reserves of for paying the interim dividend, you can, but as per the rules. Okay. Final dividend certainly can be paid out of reserves, but again, as per the rules. So there are rules, and I hope that those rules you have already studied, paying dividend out of the reserves. So whether interim or final, you can certainly utilize the reserves. Not a problem at all. And as of now, transfer to reserve is also not compulsory. Okay. So here, for the purpose of clause A, that is when we pay the dividend out of profit, before you pay any dividend, ensure that depreciation has been provided at the rate given under Schedule 2. You can certainly provide depreciation at a rate higher than what is given in Schedule 2, but not less than that, right? Because the rate of depreciation under the Companies Act and as per the Income Tax Act may differ, and those are certainly different. So that's why some of the students may have a question that why two different accounts are prepared, one for filing income with the income tax, another is prepared for filing with the ROC. These two different financial statements are for different purposes. Both are valid as per law because what is filed with the income tax department, that is for computation of tax. There the depreciation is as per the income tax act, and what is filed with the ROC, what is distributed to the shareholder, that is as per Companies Act, and depreciation is as per Schedule 2. So that's why profit figure will also differ in both of the balance sheets and both of the profit and loss account. So there is nothing wrong in preparing two different financial statements for two different purposes under two different laws. Okay, so that is a question so many students have, but generally they don't ask me, so I thought answering this question to you. Next is the board of directors of a company may declare interim dividend. So interim dividend, when it is declared, interim dividend can be declared at any time during the financial year as well as after the end of financial year, but before final dividend is declared, that is at the AGM. So at any time during the financial year as well as after the end of financial year, but before holding the annual general meeting, the board of directors can declare and pay interim dividend. Not only declare, it can also declare as well as pay. But the board will have to ensure that when they declare interim dividend, they have sufficient amount of profit available for providing for depreciation for the whole year. Because at the end of the financial year, by chance the sufficient amount of profit is not there, then what is to be done? So if the sufficient amount of profit is not there, then what is to be done after that? So that's why the board should ensure while declaring the interim dividend that there is sufficient amount of profit available for providing for depreciation for the whole year. Okay. So number 3, they say the board of directors of a company may declare interim dividend during the financial year or at any time. Okay, let me see. Nikat, am I really fast? Friends, there is a comment that I'm speaking very fast. Is it correct? Or you can understand? Surinder Kumar says, yes, I am fast. No, it is moderate. Okay, okay. So let me put a little check on my speed. It's okay. I'm comfortable because generally this is the language I use for the purpose of lecture and talk to me. Otherwise, I'll speak in Hindi. But lecture is always in English, so that's why I'm more comfortable. And anyway, that has become a practice. I'm slowing down. Okay. Thank you, Nikat, for telling me. So good. So number three, the board of directors of a company may declare interim dividend during any financial year or at any time during the period from closure of financial year till holding of the AGM out of surplus in the profit and loss account or out of profit of the financial year for which the interim dividend is sought to be declared or out of the profit generated in the financial year till the quarter preceding the date of declaration of interim dividend. So here, simple understanding that interim dividend you can pay at any time either during the financial year or after the end of financial year, but before annual general meeting is held. Because final dividend is declared in the AGM. You cannot declare interim dividend in the annual general meeting, right? Because final dividend is declared in the annual general meeting by the members on the recommendation of the board of directors. While this interim dividend is declared by the board of directors, declared and paid. Final dividend is recommended by the board and it cannot be paid unless it is approved by the members in the annual general. I have seen cases where the provisions have been misutilized. The whole amount has already been paid by the board of directors in the name of interim dividend, and in the AGM a resolution is passed as interim dividend may be treated as the final dividend itself. Right. So that is the misuse of the provisions because then the right of the shareholders has been taken away indirectly. Anyway, this is the situation. So interim dividend can be declared by the board at any time during the financial year as well as after the end of financial year, but before holding the annual general meeting. And source of interim dividend, you can pay out of the profit of the financial year in which you are declaring dividend, interim dividend. And if the interim is being declared after the end of financial year, but before AGM, then ensure it is paid out of the profit of that year only. Right? You can certainly utilize accumulated profits also for the purpose of paying interim dividend. Okay. So when you compute the profit of the current financial year, then the profit already earned up to the end of the preceding quarter. This is important. Out of profit generated in the financial year till the quarter preceding the date of declaration of interim dividend. So you can pay out of profit earned during the current financial year, but how to compute the profit, up to which date you will take into account the profit? Then profit is to be computed up to end of the preceding quarter. Now, if the company has incurred loss in the immediately during the current financial year up to the end of the quarter immediately preceding the date of declaration, such interim dividend shall not be declared at a rate higher than the average dividend provided declared by the company during immediately preceding three financial years. So if the company is having loss during current financial year, then how come interim dividend? Then this is out of profits, or rather out of accumulated profits. So this is being said that that rate of dividend shall not be higher than the average rate of dividend declared by the company during preceding three financial years. So this rule applies otherwise also. Whenever you pay dividend out of reserves, you have to ensure that the rate of dividend is not more than the average rate of dividend during preceding three financial years, and that you are already aware of. So that equally applies even for interim dividend also. Now, number 4 says the amount of interim dividend, including amount of dividend including interim dividend. Now this wording is not required at all. This is amount of dividend including interim dividend. When the definition of the term dividend itself says that the amount of dividend includes interim dividend, why it is given separately? Right? Do you remember the definition of dividend? Or I show you that separately again? So those who are not aware how to see two parts of the document, see, go to the view section, then check split and bring the line here, and now the same document is in two parts. Okay, both parts you can move separately. I'm moving on the upper part and I'm going to page number, say, 21. This is closed. So on the lower side there is another page open, on the upper side I'm opening this, the term definition. See this one. Can you see it now? Section 2, subsection 35, this defines a dividend. Tamil, good morning. So dividend includes interim dividend. Then why it is given here, again I fail to understand. Why it is given here? Not required. Right? So whatever provisions are applicable to dividend, all those are equally applicable to interim dividend also. So this was not required. So you see, in the Companies Act 2013, that was implemented in a very hurriedly. Why, we don't know. And when it was implemented, I pointed out number of errors in this law. And over a period of time, those will be taken care of. So this is one case where it is a simple error. Why they have been given separately, including interim dividend? Forget that. So, and whenever dividend is declared, the amount of dividend is required to be deposited in a scheduled bank within 5 days from. So these are 5 days after declaration of dividend. That day is not covered in that, the date of declaration. Otherwise, that will become 4 days, because the date of declaration plus 4 days, that will make 5. But here it says separate account within 5 days from the date of declaration, means the date of declaration is excluded in the, or you can say within next 5 days. Right? That will make the things much more simpler, that the amount of dividend is required to be deposited in a separate bank account in the scheduled bank within 5 days after the declaration of dividend. Number 5. No dividend shall be paid by company in respect of any share therein except to the registered holder of such shares to whose order or his banker shall not be payable except in cash. So two things are given. Number 1, dividend is always in cash. You cannot pay dividend in kind. But bonus shares are not the dividend. Bonus shares are not a dividend. Bonus shares are treated differently as far as law is concerned. So here you cannot give anything to the shareholders otherwise than by way of dividend in kind. Earlier, around 25 years back, there was a practice of giving the gifts to the shareholders who were attending the annual general meeting. Some of the people objected to that the people or the members of the company who are resident of the same city where the registered office is situated, they can attend the AGM. And by being able to attend, they are entitled for extra gifts. And that was treated in law as a dividend. So MCA issued a direction that no gifts should be given to the members or shareholders who are attending annual general meeting or any general meeting. That will be treated as a dividend in cash, or rather dividend in kind. So either give to all or don't give to anyone. So that's why now we have in law itself the dividend is payable in cash only, and this is payable only to the registered holder or to the banker. So the concept of banker being appointed for receiving the dividend is a historical concept, not now. Now proviso says provided that nothing in this subsection shall be deemed to prohibit the capitalization. So this is about the issue of bonus shares. Now, any questions? Now, Nikhil, you can tell me whether I have reduced my speed or not. I tried to control, but I don't know. Thank you. Moving to the next section, section 124. This is unpaid dividend account. So question of unpaid dividend account comes after the amount of dividend has been transferred to a separate bank account. So there is a sequence that first of all dividend is declared, then this is transferred to the dividend account. From dividend that comes to unpaid dividend account, and from unpaid dividend account it goes to next account where the amount goes to the account of government. Okay, so here it is said that when the dividend has been transferred to a separate bank account, and if it is not paid or claimed within 5 days, then it should be transferred to unpaid or unclaimed dividend account, right? And then the amount will remain therein up to the end of 7 years since the date it was transferred. From there, it can be paid or claimed, and if it is not, then on expiry of 7 years, they should be transferred to Investors Education and Protection Fund. And once it is transferred to Investor Education and Protection Fund, then responsibility of the company comes to end. Okay, so here we'll see what is given in the section. This is where a dividend has been declared by the company but has not been paid or claimed within 30 days from the date of declaration to the shareholders entitled to the payment of dividend. The company shall, within 7 days from the expiry of the said period of 30 days, transfer the total amount of the dividend within the remaining unpaid or unclaimed to a special account to be opened by the company in that behalf in any scheduled bank to be called as unpaid dividend account. Now, this is again something wrong in the section. Practically, the dividend account you cannot change. If you have a dividend account, say in a State Bank of India, you cannot open unpaid dividend account in Axis Bank. This language shows that only that you can do that. Practically impossible. What is done practically is when we open a dividend account, at the same time in the resolution itself we mention that the name of account will be changed from dividend account to unpaid dividend account. Right? So many mistakes in law because this was implemented in so much of hurry that nobody really knows why it was done. Right? What was so much of hurry for so many errors are there in law? And this was when the last government was going out. So late night, it was approved. Late night, generally laws are not approved, but it was approved late night. And I was looking at the direct telecast, and the people who approved that, they never understood even a single word out of company law. They were approving the law. Government wants to take control. No, that was somebody wanted to take the credit for the implementation of the new law. Government cannot take control of the law. Okay. Amendments are being brought in regularly. You see, but since that does not affect a common person on a day basis, that's why all the amendments are not required. Now, this kind of interpretation which I'm giving you, a lot of people really don't understand the value of the, right? So as long as it is not affecting people on day-to-day basis, amendments are not desired. Law is implemented through interpretation. Okay. So that's why interpretation is needed. You must have read the chapter of interpretation. No, it is not wrong. It is not wrong. It is poorly drafted. Right. We'll not say it is wrong. We are not the judges to decide whether it is right or wrong. Whatever is given, that is the law for us, but it should have been drafted correctly. Dividend limit. You said dividend limit is not clear. If we can say that we can pay dividend last 3 years average, but if the dividend is not paid in any of the 3 years, then what is the limit? Then the limit doesn't apply. It is simple. 5 then 7.5%. No, those are not the limits. That was for the transfer to reserves. No limit for the rate of dividend. If you don't have any dividend during preceding 3 years, that condition does not apply. Then the sky is the limit. Okay. Then certainly the government is going to ask you that when you have not paid anything during preceding 3 years, then what is the need of paying much substantial amount out of the reserves during current year? That if you have an explanation for that, then you can pay any amount of dividend. You know, you must have read one word. I'm giving you some very interesting things. The word comes reasonable, right? Yes, we'll see how much notes I can give you. See, you must have read the word reasonable. What is the meaning of the word reasonable? Anybody can tell me what is the meaning of the word reasonable? Reason. Whatever you can justify, that is reasonable, right? So when we use the word reasonable in law, then everything has to be within the framework of law, right? That is called reasonable. Reasonable does not mean negotiation and understanding and convenience for both the parties. Okay. So reasonable word is as per law, that is within the framework of law, right? And justifiable. That is called reasonable. Okay. By chance, the time is very, very less. Otherwise, I would have given you so much of information about law. It is helpful. Anyway, so once the dividend is transferred to the dividend account, it is not paid or claimed for 30 days, then within next 7 days, it is transferred to a separate bank account that is called unpaid or unclaimed dividend. And there it will remain up to end of 7 years. The company shall, within a period of 90 days of making any transfer of to unpaid or claimed dividend account, prepare a statement containing the name, their last name, etc. Now, this information is published, made available to the government, and number 5, that any money transferred to this account in pursuance of this section shall remain unpaid or unclaimed for a period of 7 years from the date of transfer. This is important. From the date of such a transfer, right? The dates are important. From which date? So 7 years are taken from the date of such a transfer shall be transferred with, along with the interest accrued, if any. So why the interest should accrue? Is there any possibility of the interest on this account? This amount is in the current account and no interest accrues on this. Okay, no interest accrues on this account. If any, thereon to the fund established under Section 125, this is Investor Education Protection Fund. And all the shares in respect of which dividend has not been paid or claimed for 7 consecutive years or more shall also be transferred to the company in the name of Investor Education Fund. right? So here the word also is missing. So that along with dividend, even the share should also be transferred. Provided that the claimant of any shares transferred above shall be entitled to claim the transfer of shares from the fund in accordance with the procedure and on submission of the heap as may be prescribed. So shares transferred can be taken back. So if the person has been sleeping for 7 years, the chances of his waking up are very, very less. So effectively, the government takes control of those shares also after expiry of 7 years, in respect of which dividend has not been claimed. Dividend is not available again. Shares can be taken back. Now, penalty, we are not reading. Section 125. In this, only one question can be there, that which are the amounts which are required to be transferred to this fund. Can anyone claim? No, there should be a legal right to, it should be justifiable. Who can claim those shares? So anyone means what? So as long as the legal right is there, the person can claim. Yes, shareholder can claim, and if the shareholders no more is legal heirs can claim. What is tomorrow if somebody is asking you in what capacity you are applying for those shares, what is the justification? If you have a justification, you can claim. Claiming is your right. Giving back, that is the government right. Okay. So how much, or rather which are the amounts required to be transferred to this fund? So there shall be credited to the fund subsection 2. This is important for you for the purpose of exam. Which are the funds required to be transferred to this fund? Okay. So I'm just keeping it highlighted so that when you get the copy, you can make use of this. So I have done everything red color for you. Which are the amounts required to be transferred? So number one, the amount given by the government by way of grants. By chance, if the grant is not utilized, that should be transferred. The donations given to the fund by central government. Then the amount of unpaid. So first two, these are given by government. So let us put it in a different color. Let us put it this way. Okay. Then the amount of unpaid dividend account, then the general revenue account of the central government, then amount lying in the investor education protection fund under section 205C of the Companies Act, old one. So actually this should have been number one, right? So first of all, the money coming from the old account. Anyway, this is no more relevant for you as of now. The interest on the other income received out of the investments made from the fund, the amount received under section 38, application money, mature deposits, mature debentures, interest accrued, sale proceeds of fractional shares. So all these are the funds which are required to be transferred to Investor Education Protection Fund, but only after expiry of 7 years from the relevant date. Okay, so except this question, generally there will not be any question. So it says the fund shall be utilized for the refund of the unclaimed dividend. Generally, dividend is not refunded. Other amounts are refundable, but not the dividend amount. And other things, as far as shares are concerned, those can always be claimed back. Let's go ahead. Time is less, and we have to do so much. Right of dividend, right shares and bonus shares to be held in abeyance pending registration or transfer of shares. So when this is applicable. So first of all, what is the meaning of abeyance? Abeyance simply means keeping the things pending. Keeping the things pending. And why this section? First one is important, dividend. When the dividend is required to be paid, immediately after declaration, you can pay dividend. Once you transfer the amount to the dividend account, therefrom it can be paid dividend. You are required to transfer within 5 days, and if it is not paid within 30 days since the declaration, then the amount is required to be transferred to unpaid, unclaimed dividend account, etc. But where the right to receive the dividend itself is not clear, then to whom dividend should be. As of now, it will not be difficult for you in the listed companies because all that is done in the demat form. But in closely held companies, this situation may arise again. Okay. So why the situation? Because some of the shareholders may not be available for one or other reason, or maybe he has sold the shares, but the transfer has not been registered in the name of transferee. The law says shares, the dividend should be paid to the registered holder, and he has already transferred his shares to somebody else. The transfer has not been registered in the name of the transferee. Then this amount is to be kept in abeyance, right? Or there is some other dispute going on for as far as the right to receive the dividend is concerned. So company is not there to decide who is the right person to get the dividend. So whenever for any reason it is brought to the knowledge of the company that there is a serious dispute other than transfer as well, then dividend is not to be paid to anyone. Company can keep that amount in away. Of course, company is legally protected that company has paid the dividend to the registered holder. And company can always do that. But this is something which goes in favor of the company. And this is protecting the directors of the company from the from penal provisions. The dividend shall not be paid if there is a dispute. Right. So as far as this particular section is concerned, this is only talking about one situation, that when the registration and when the transfer has not been registered in the name of transferee, but otherwise this happens whenever it is brought to the knowledge of the company in writing and maybe under the proper authority of law that there is some dispute or some issue going on in relation to the dividend, then the dividend shall not be paid to anyone. Not only dividend, the right offer of the shares will not be given, the owner shares shall not be given, and in a given situation, even right to receive the right shares may be lost. Of course, it's a long process, so that cannot be discussed here. But whenever there is a dispute, the amount of dividend, the offer of right share, the issue of bonus share, that can be kept in abeyance for a certain period of time till the dispute is determined. And when the amount of dividend is kept in abeyance, it is not a violation of section 127. That does not attract. So here comes section 127. This is the last section as far as dividend portion is concerned. And this is payment for punishment for failure to distribute dividend. Now you have to understand the word, what is failure? Failure means what? Failure is intentional. Failure word is intentional. And when there is an inability to do something, that is not considered as a failure because intention is missing. So penalties are based on intention; those are not based on the outcome of the activity. So if there is an intention, there is punishment. If there is no intention, there is no punishment. It is simple. So this section says, but a dividend has been declared by the company but has not been paid. Now, payment means what? Payment of dividend is simply transfer of amount to the separate bank account, and posting of dividend warrant itself is treated as a payment of dividend. Once the checks are issued, once the dividend warrants are issued, it is as good as a payment. If that is not even issued, then certainly it becomes a serious business that you are required to simply issue a check, you are required to issue a dividend warrant. Whether it reaches the recipient or not, that is none of the responsibility of the company. If it is raised, whether it is encashed by him or not, that is none of the responsibility of the company. He has deposited with the bank, but bank has not given him credit, that is not the responsibility of the company. Responsibility of the company is only up to sending the relevant instrument to the member so that he can claim dividend. And as of now, for the listed companies, everything goes in demat form. Unless somebody has specially requested the company to pay the dividend through the dividend warrant physical form, till now, or rather in current scenario, everything goes through ECS. So shareholders only gets a SMS that this much amount has been credited, right? No dividend warrants. As per law, the moment dividend warrants have been sent, right? And if it is a closely held company, very limited number of shareholders, there may not be dividend warrant, there can be only checks. So as soon as those are issued, dividend is deemed to have been paid. It is a deeming provision, right? You understand what is the meaning of deemed? Give me one word meaning for the word deemed. One word meaning for the word deemed. Yes, this is presumption, implied, right? So there is a presumption actually. This is presumed that. Okay, so this goes as presumed. So where a dividend has been declared by the company but has not been paid, or the warrant in respect thereof has not been posted within 30 days from the date of declaration to any shareholder entitled to the payment of dividend, then every director of the company who is punishable. Yes. Every director of the company shall, if he is knowingly a party to default, be punishable with imprisonment which may extend to 2 years, and with fine which shall not be less than 1,000 rupees for every day during which the default continues, and company shall be liable to pay simple interest at the rate of 18% per annum during the period for which the default continues. So in this, what is the minimum imprisonment? In this case, what is the minimum imprisonment? The section is in front of you. What is minimum imprisonment? Prafulla, that is 2 years is max. What is minimum? Is it written anywhere not less than 6 months? Where do you find not less than 6 months? (447) doesn't apply. This is not a cheating or fraud. When you see, this is understanding. So just understand. When it says which extends up to, okay, and it doesn't say not less than, it means minimum is 0. Minimum is 0, right? In GST, you must have read imprisonment up to 3 years or up to 7 years, but not less than 6 months or 1 year or 3 years, right? So their minimum is also given, but here it says which may extend. It is not giving you minimum. Okay. Now see the next line that will give you further explanation, which shall not be less than 1,000 rupees for every day. Now this 1,000 is minimum. What can be maximum? What can be maximum fine? No limit. Okay. So as far as imprisonment is concerned, they have given the maximum. As far as fine is concerned, it is given a minimum. In both cases, so much of discretion is available to the judicial authority. And that's the reason for so much of discretion. Why so much of discretion is to be given to one person? If you're providing for imprisonment, this is a very specific default. Judicial authority should have a discretion only to decide whether the offense is there or not. Penalty should be there in the law. Why give so much of discretion? Anyway, provided that no offense shall be deemed to have been committed. What is the meaning of this? no offense is deemed to have been committed. It means prima facie there is an offense. Offense of dividend not being paid. But it will not be treated as an offense in any of these following conditions. Number A, but the dividend could not be paid for want of reason of operation of law. Any example for where dividend is not paid for operation of law? In case of transmission that is held in abeyance, right? Say, for example, some investigation is going on regarding ownership of shares. I hope that investigation chapter you have read. Of course, I have not covered, but I am presuming that you have read about the investigation of ownership of shares. So when investigation is going on in relation to the ownership of shares, quite possible an order is passed to the company that no dividend ought to be paid about these shares as long as investigation is on. So on one side you are giving an order not to pay dividend, on the other side you make the same offense punishable, it will be contra. That's why this is the case, right? Maybe right now you can take another example that in some Indian company there are some Chinese investment. And tomorrow, Government of India imposes a restriction that no remittance of money on the investment made by the Chinese entities in India. What will you do? That is prohibited by law. When FERA was there, of course, you have not seen that era of FERA. I have seen that practically. We really struggled to remit a dividend to the non-resident Indians. Every time we are required to get the approval of RBI for remittance of dividend to non-resident Indian shareholders. Get the approval of RBI. That was FERA, not in FEMA now. Now you can directly remit them. Okay, so where dividend could not be paid for reason of operation of law. Number B, where the shareholder has given a direction to the company regarding payment of dividend and those directions cannot be complied with and the same has been communicated to. Now, again an example. Law says the dividend should be paid only to the registered member whose name appears in the register of member on the day when dividend is due. And the shareholder has given instruction that instead of paying the dividend to me, you can pay this amount of dividend on my behalf to somebody. Company cannot do that. So if company has informed that person that we cannot comply with this, either you take it or it will be pending, then in that situation, there is no offense. Number C, where there is a dispute regarding the right to receive the dividend, company cannot take a decision to whom dividend should be paid, but company is legally protected where the dividend is paid to the registered member, and that is already provided in the section 120. Number D, where the dividend has been lawfully adjusted by company against any sum due to it from the shareholder. Now, assume that the shareholder of the company is also a customer of the company. The company is an electricity company, and the shareholder has not paid electricity bills of the company for last 3 months. Dividend is declared now. Can that amount of dividend be adjusted against that electricity bill? One answer no, somebody says yes. Yes. Don't think, give me an answer. You are advisor to the company. As a company secretary, you are advising. Oh my God, so many confusions. Anyway, let me clarify. Any amount due from shareholder in the capacity of shareholder. in the capacity of shareholder, only two amounts are due. Either amount of capital or premium thereon, or at the most any interest on delayed payment. Right? Here, the relation of the share with the company is one category. His relationship as a customer with the company, that is another relationship, and two different relations cannot be clubbed together. So company cannot adjust this money against the electricity bill due from the shareholder. So you see, this makes sometimes very important. So this is any sum due, but from whom? From the shareholder. This money is due in the capacity of shareholder. It doesn't say any money due from any person. Had it any money due from any person, then that would have been a different story, because every person is not paid dividend. Dividend is paid only to the members. So this relationship is in the capacity of the member only. So as a member, what is liable to pay? He is liable to pay only the amount of capital plus any premium on that. If there is any delay in payment of capital, there can be some interest. Nothing other than that. Okay. So I hope all of you got the answer. Who said yes? Nothing can be adjusted toward the electricity bill. Okay. I know law is not a subject of self-study. By chance, this is a serious mistake committed by the students, presuming that law is a subject of self-study. It is never. This is the deepest subject, much deeper than any practical subject, whether it is accounts or finance or taxation or whatever. Law is much deeper, and you can understand the fact that one case can go on for 20 years, 30 years, 40 years, because law has got so much of depth. It is not a subject of self-study. Better you study this subject under guidance. Okay, so this is just one example that what was your present, what I gave you. Okay, so make it sure that law is not read as a self-study subject. This is not theory. This is the most practical subject. Number E, where for any other reason the failure to pay the dividend or to post the dividend warrant within the period under this section was not due to any default on part of the company. Now, this situation you cannot imagine, but I will give you an example. It was year 91, 92. I was working as a chief secretary for a group of companies. We had appointed an agent for posting of dividend warrants, because at that time there was only solution paying through the dividend warrant. There was no concept of ECS. Okay. Thousands and thousands of warrants we gave it to one agency for posting to the shareholder. The agency gave us a confirmation they have posted. We had a proper given by the agency that they have posted all the warrants, but they did not post it all. Right? Shareholders did not receive it. Company was continuously getting information from the bank that amount no dividend is being claimed and no debit is coming. What is happening? And we said that there maybe somewhere those are stuck up in the post. We are not responsible. Later on, we discovered that it was not posted. So number E fits into that. Beyond the control of company, that we have given the responsibility to somebody else and he gave us a confirmation, so we did not have any opportunity to find whether it has been posted or not. Later on, when nothing is debited and complaints started coming from shareholders, we tried to find out, and then we discovered that this agency to whom we had handed over the task, they had not posted any dividend warrants. So this is one example where you can say this is beyond the control. When beyond the control, so ultimately this is not intentional. So intention was that the amount of dividend has been transferred to a separate bank account, and we have also given the dividend warrants to the agency. Now it was the agency to. So intention was missing, therefore that's why there was no penalty. So section 127 is there, on which usually you can find questions in the exam. Generally questions are there from section. So when the penalty will not be there, we can read it as a whole. Number one, where the dividend could not be paid for reason of the operation of any law. Number B, shareholder has given a direction that cannot be complied with. Number C, whether there is a dispute regarding the right to receive dividend. Number 4, whether dividend has been lawfully adjusted against the call against the money. And number E, where for any reason the failure to pay the dividend or to post the warrant within the period specified in the section was not due to any default on the part of company. So this brings us to the end of Companies Act as far as the chapter of dividend is concerned. We can spend some time for discussing and before we go to the next chapter. Now the chat box is on. So there was some long question. Let me read it. Okay, you have written such a long question here. I don't have so much of space to read. Company paid dividend to holder of shares at the time of announcement of the actual date of payment. And can the receiver of the interim dividend, final dividend are different? And can dividend to be paid to the minor who receives shares from? You see, these long questions you can put me on the group, because reading here that will take the time of everybody on this time. This is crucial. Do post it on the group. I will answer that. Okay, so right now I am not reading it out. In case of inadequacy of profit paid out of reserves and surplus profits if you have any. Giving notes, I think this is a little difficult right now, but certainly I'll try to do that. So what is this CO Act? Rapuri. Can you repeat the question? What is the CO? Yes, this is Companies Act. Certainly, I'm referring to the text of the company law, and I keep it updated on day-to-day basis. This is my personal document, and this I'm going to share with all of you today in the group. The group which I have created on Facebook, or rather on the WhatsApp. So not only today, since I keep on updating that, so every time I update, I will again send it to you. So you may find multiple postings of the Companies Act, but there is always refer to the latest document which I sent. So I will include all the amendments there. I'll keep on posting the things again and again on the group. So this is certainly Companies Act. The classes, personal classes, we will speak after this class is over. Can dividend be paid proportionally to the amount paid up? Lakshmi, I think you missed some class. There was a chapter of capital, share capital, in which it was clearly mentioned that company can make provisions in the article for paying dividend on the basis of amount paid up capital on the shares. Right? So dividend is always paid in proportion of share capital paid up. If this is not the case, then you imagine what will happen. Somebody has paid 5 rupees on the share, another person has paid 10 rupees on the share, and both are paid the same dividend, then who's fool? Right? So dividend is always paid in proportion of the amount of capital paid up on those shares. Can I pay dividend out of capital profits? If yes, what are the cases? Number one, did you read anywhere in the entire provision that the dividend should be paid out of revenue profits? This is only talking about profits. It is not talking about revenue profits or capital profits. So whether it is capital profit or revenue profit, you can certainly always pay dividend out of capital profits as well. Okay, but it is not advisable. It is not a commercial prudent decision to pay dividend out of capital profits. Capital profits are not generated on day-to-day basis. So those are once in a while, and that should be utilized for a different purpose, for expansion of the business or for doing something for the business, so that company can sustain for a longer period of time. Okay, so it is not desirable to pay, but not a prohibition under company law. That was a long time back, an interpretation given by the Institute of Chartered Accountants. They have their own whims and fancies. So they make some provision under, well, I don't know where from they have brought that concept that dividend cannot be paid out of capital profit. You have read the entire chapter, right? Once again, I'll show you here where from you can pay dividend. 123, where from you can pay dividend. This is out of profit of the year arrived at after providing for depreciation. This is what word it is using. It is simply saying out of profit. Does it say revenue profit or capital profit? It does not. Profit may be capital, profit may be revenue, and you can utilize that for payment of. Rohit, I think you got the answer. Which WhatsApp group? I am running my own WhatsApp group. You have my number. You can connect to me. I'll share the link to join the group. If you're not a part of it, you can send me the. Is a certain case law, it is said if in AGM company failed to give dividend, it can pay in AGM. No, that is the old historical case law. If you fail to declare dividend in the AGM, how can you finalize the financial statement without declaring dividend? And once you finalize the financial statement, then how you can declare the dividend? Because the declaration of dividend will have the impact of changing the financial statement. So either financial statements are or the dividend is not declared. Both have to be done in the same meeting, and that is in the AGM only. Don't refer such case laws. So the procedure for claiming unpaid after 7 years. So there is a specific format given. You make the application, but as I said, generally dividend is not repaid. If in the AGM company failed to pay, no, it cannot pay dividend. No, it's the personal class you're going to deal with. They got no questions here about the personal class. This is ICSI platform. On this, no question as far as personal class is concerned. Okay, I'm sorry about that, but that we can talk personally, not on this platform. Okay, so this is platform for given by ICSI. This is free for all, and I'm giving my best possible here. To the next chapter, to the chapter of accounts. So here we have accounts of the company, section 128 to section 138. Those are covered in this chapter. So section 128, this is talking about books of account to be kept by the company. Section 128, subsection 1, this is every company. So when we say every company, whether this is private company or public company, listed company, unlisted company, government company, every company is covered in this, but it does not cover foreign company. Right? That is a statement that when we say every company does not cover foreign company, why? Answer I have given you, but now the question is why? No, later on we will see under the provisions applicable to foreign companies that in relation to business in India, they have to follow these provisions. But not to section 128 covers them. This becomes indirectly applicable, but not direct. Right? So here we say every company. Company means which is incorporated under company law in India under this act or under previous shall prepare and keep at the registered office. So here I have already mentioned where the books are required to be kept. Now, before we go into this, read here. Books of account and other relevant books and paper. What is the difference between books of account and other relevant books and papers? When we say books of account under company law, we will not talk about the ledger or journal or some other document. Law simply says that company is required to keep a record of all the transactions pertaining to whatever is spent, whatever is received, whatever is going out, whatever purchased, whatever sold. Keep a record of all that. But by what name you call the books of account? None of the business of the company. Whatever name you want to give it, but there should be a complete record of every money received and every penny going out, every purchase, every sale, every refund, every transaction has to be recorded properly in a true and fair manner and as per accounting standards provided by the law. Okay, so here it says the books of account and other relevant books and papers. These are important definitions. For that, we will go to the definition section, right? So again, splitting it, okay, and here, page number 21, and here comes, see here, the definition. First, you see the books of account. Let me put it on a separate page for you. That will make it simple for you to see both the definition. Okay, so this we can adjust how much portion we want to see. So books and papers and books of account, these are different definitions and both are covered together in that under section 128. So books of account includes a record maintained. See here what it says. This includes. It is not saying books of account means. Right. So other than that also there can be books of account. So record maintained in respect of all sums of money received and expended by a company and matters in relation to which receipts and expenditure takes place. So matters in relation, this is also something important because you just cannot say that debits and credit, that this is received, this is spent. In relation to what it is received, in relation to what this is spent, that should also be recorded properly. So the amount received as capital, that will be credited in the capital account. Amount received for the sale of the goods or providing the services, that will be credited as a revenue income. So the reason for every transaction or the background of every transaction should also be recorded. This is all sales and purchase of the services. Now, when all sales and purchases are being recorded, then how come the money received and expenditure are different? This is not covered in number 1 itself. Point number 2 is covered in number 1 or not? Every sale is not equal to money received. Sale may be on credit. Similarly, every penny going out, every rupee going out does not mean expenditure. That may be purchase, that may be some other expenditure, that may be investment, right? So these 2 points, which prima facie looks similar, those are not similar at all. We're talking about all the money received and spent. Number 2 is only about sales and purchases, right? So you can have n number of other incomes which are covered in point number 1. So other than sale and purchase also there can be transactions in. Then the assets and liabilities. You are required to maintain an asset register and liabilities record. So liabilities record something in relation to charges we already talked about. And other than that also there can be charge liabilities. Then items of cost has been prescribed under section 148 in the case of company which belongs to any class of company is specified under this. So these are called books of account. Now see books and paper. Books and paper is a much broader definition. They say books and paper and books or paper include books of account, deeds, voucher, writings, documents, minutes, and register maintained or electronic form. So here you can say that every voucher, every agreement, every contract, every receipt, etc., which is in support of an entry made in the books of account, that is also covered here. So not only books of account, but every document supporting the entry in the books of account, that will be covered in the books of papers. Clear? Right. So simple reading may give a confusion. So now read it here. So every company shall prepare a keep at its registered office what? Books of account and other relevant books and papers. Getting it? So don't read plainly. Whenever there is any technical term, go to section 2, refer the definition, come back. So books of account as well as books and papers and financial statements for every financial year, which give a true and fair view. What is required? Right. So what is required is here we can add registered office and true and fair. This word was missing by chance, so I have added it. So it comes true and fair view of the state of affairs of the company, including that of the branch office. If any explained transaction affected both at the registered office, branch office, and shall be kept on accrual basis and according to the double entry system of accounting. So all the things I have kept here. The company is required to keep the books of account at the registered office. That is the first preference. That is not the final thing, right? Because keep in the digital form, and if you are keeping the digital form, the place of keeping at the registered office does not arise. But if it is in the physical form, and so primary requirement is keeping the books of account at the registered office, and not only books of account, then including all other books and papers, which are in support of every entry made in the books of account that should be kept at the registered office in such a manner so that it is showing the true and fair view of the state of affairs of the company, and it is these are prepared on the double entry system, and the accounting is done on the accrual basis. So all 4 points are covered here in. Right? So look at these points. I'll take 1 minute break, then I'm coming back. In the meantime, read this one. Okay? Read this thoroughly. I'm coming back in a minute. So now I'm back. Any questions? Accrual basis and credit sales, these you can say more or less these are same. So accrual basis includes cash because whatever you have already received that will be recorded plus whatever is on credit sale that is also shown as a sale. Any more questions you have? So now coming to the proviso, provided that all or any of the books of account aforesaid and other relevant papers may be kept at such other place in India. This is important. So when we say other place, so other place, but that should be in India. You cannot keep your books of account outside India because when it is said that you can keep it other place also. The board of directors can take a decision to by passing a resolution that the books of account may be kept at some other place, not at the registered office, because subsection 1 says it is at the registered office, but board can pass a resolution to keep the books of account at a place which is not the registered office, but that place should be in India. Why? Now, the question to you, it says in India, but the question is why? Why in India only? So books of account are not open for inspection by members. Right? There are n number of reasons, and the most important reason is yes, inspection by the authorities. Government of India is having control only within Indian territory. If people tries to maintain the books of account outside India, then that will be as per law prevailing there. Indian authorities will not be entitled to inspect for the simple reason that inspection, investigation, etc. That's why this other place has to be within India. So whenever board passes such a resolution to maintain the books of account at a place other than the registered office, then the intimation of the other place should be filed with ROC within 7 days after that. So not 7 days after keeping the books at other place. So within 7 days after a resolution has been passed by the board. And the option has been given to you for keeping the books of account in the electronic form, that is second proviso. And when you keep the books of account in the electronic form, that ensure that there is a sufficient backup system, there is a retrieval system, and if required, you will provide all the information to the government authority. That is a commitment has to be made. Subsection 2 is talking about the books of account of the branch office. So whatever transactions are done at the branch office, whether in India or outside India, the transactions shall be recorded the branch itself, and it is sufficient if a summary of the transactions is sent at the place where the main books of account are kept. And all the documents, information sent from the branch office should be maintained by the head office where the books are maintained as it is. Coming to subsection 3, this is important, on which number of times practical questions have been asked that shareholder want to inspect the books of account, whether those are open or not. As far as subsection 3 is concerned, this is not giving a right to the members to open the books of account or to inspect the books of account. However, if the company is willing to offer inspection of books of account to the member, it is not a violation, it is not an offense. But the question is whether member can claim a rightful inspection of the books of account. Answer is simple. Member does not have any statutory right to inspect the books of account of the company, except one case where there is a holding subsidiary company relationship. The holding company can appoint a representative to inspect the books of account of the subsidiary company. That's the only one case where the member has been given a right to inspect the books of account of the company. Otherwise, in any other situation, the members do not have any statutory right to inspect the books of account of the company. The right is available to the directors, and that too only personally. The books of account can be inspected by the directors of the company, but purely in personal capacity, not through any authorized person, not through any agent. So they can inspect the books, but personally. Okay. So the books of account and other books and papers maintained by the company within India shall be open for inspection at the registered office of the company or at such other place in India by any director during business hours. And in case of financial information, if any maintained outside India, copies of such financial information shall be maintained and produced for inspection by the director subject to such condition as may be prescribed. So where the branch is outside India, the books of account are maintained at the branch, and some director in India wants information about that transaction which are recorded therein, then information should be called from the branch office situated outside India, and that should also be made available to the members in India. Okay. If books of account are kept at other registered office, okay, some question is there. Let me see. disclose in annual return, nothing of this sort. No information required to be given to the shareholder. The books of account are not open for inspection by the members. In annual return also, this is not required to be given. So this is the right available to the directors. Directors are aware of, they have passed a resolution in, then the right is available to the officer. So information is filed with the ROC. So no information is required to be given to the shareholders or in the annual return. Okay. So here comes, provided that inspection in respect of subsidiary of the company shall be done only by the person authorized on behalf of the resolution by the board. So this is only exception where member has been given a right to inspect the books of account. Holding company is the member of subsidiary company. Holding company is the member of subsidiary company. No permission is required. Board passes a resolution and the copy of resolution is filed with the ROC. No permission required. Only information, that too after passing the resolution. So here comes, provided that inspection in respect of subsidiary. So this is the only case where the member is having a statutory right to inspect the books of account of the company. Other than this, no other member is having the right. Only directors are having the right, and that too in personal capacity. Right. And you see here, in subsection 3, they have been given a right to inspect. If they want to take some copy of that, that right does not exist. They want to take extracts from the books of account, that right does not exist. Company voluntarily giving them, it's okay. But the question of right is not that. Then period of preservation, for how long the books of account shall be preserved by the company. So this says for the period of preceding 8 financial years. But when the company has not completed 8 years since incorporation, then in respect of all the financial years which are completed after the date of incorporation till now. Right. And where some inspection, some investigation, some other legal proceedings are going on, then the books shall be preserved until all that period, all those inquiry, inspection, investigation is over. And there are also situations where the government may require preservation for a much longer period of time. So if much longer period is required, then those should be kept there. And subsection 6 is talking about the penalties. So penalties generally I do not discuss. And as you know that this is not asked, but under this subsection 6, this is applicable in multiple places, same provisions are there. So better you read about this. So who is punishable? The company is punishable, but in addition to company, the certain individuals who are responsible, who are doing the offense intentionally, they are punishable. So this is the managing director, whole-time director, or the CFO, or any other person in the company charged by the board with the duty of complying with the provisions, contravening the provisions, that such MD, whole-time director, CFO, or the person shall be punishable with imprisonment for a term which may extend to 1 year, of fine which shall not be less than 150,000 rupees, which may extend to 5 lakhs or with both. So penalty is there on the managing director, whole-time director, or chief financial officer, or some other person who is made responsible. So whenever you are appointed as a company secretary in the company, generally this happens that a resolution is passed under subsection 6 that from today onwards you will be responsible. Do not take such a responsibility till you know the company. Right. This is generally happening that the moment a fresher is appointed as a company secretary, a resolution is passed that from today onwards all the responsibility is on his shoulders, and you don't know ABCD about the accounts of that company, but you take the responsibility. Don't do that. Okay. So till you know the company, till you are sure that all the books are being kept properly, you are also very well versed about the accounting systems, then only accept the responsibility. Otherwise, let this responsibility of books of account be on the CFO. As a company secretary, my sincere request to you, or rather a very strong suggestion, never accept responsibility for keeping the books of account, for proper maintenance of books of account, because almost in every company there are problems in the books of account. Let this be the responsibility of CFO, not yours. Okay. So that was about section 128, and now we go to financial statements. What are called financial statements? Quickly, what is the meaning of the financial statements? So those who know, they can answer, and those who don't know, that don't bluff. Is it defined or it is knowing? You know that. The term financial statement is defined or it is known to you? Answer is already there on the screen for you. See, the answer is already written. What I'm asking is answer is already there on the screen for you. So financial statement term is defined under section 2 subsection 40. Got it? So answer is already there on the screen, and then I ask the question. Now it is defined therein. Now we will refer the definition. So financial statements, this we can see the whole definition here. So financial statement in relation to company includes. It doesn't say it to me, but indirectly it means only. Number one, a balance sheet. Balance sheet is always as on a particular day. You cannot say balance sheet for the financial year. Balance sheet is always on a particular date. So there's a balance sheet as at the end of financial year. Number two, a profit and loss account, or in case of company carrying on activity not for profit, and income and expenditure statement for the financial year. Now see the difference. This is for the financial year. And here it is saying, Meenakshi, voice is not clear, audible. Other people, whether I'm audible or not. So Meenakshi, some problem at your end. See how many people are responding. I'm audible. Meenakshi, get a good net connection. So these problems may not arise, because now onwards you will have to learn everything sitting in front of computers only. No more physical classes now onwards in the whole world. You have to learn sitting in front of computers only, and classes will always be held distant. So you have to have very good internet connection. So just a suggestion, choice is yours. And later on, in any case, the video is going to be uploaded on YouTube. You can refer it there. And if that is not, then I am always available to help you out. Next. So understood the difference between balance sheet and profit and loss account? The balance sheet is always as on a particular date. You can draw balance sheet on day-to-day basis as well, not a problem at all. But it doesn't make it doesn't help you in any way by making the balance sheet daily. You have the softwares now for the purpose of accounting. Just press the switch and the balance sheet is in front of you. But that is not of any use. That's why balance sheet is prepared only on the last day of the financial year, and profit and loss account is prepared for the whole financial year. So that shows whatever is inflow during the financial year, whatever is outflow, what is remaining, that is called gross profit, and then you book certain taxes therein, then you arrive at the net profit, then comes appropriation of profit. So this is what the thing is. So balance sheet, profit and loss account. Number 3, cash flow statement for the financial year. This is not saying at the end of financial year. One word makes a difference. This is also for the financial year. A statement of changes in equity if applicable. So during the financial year, is there any change in the equity capital? So whether there is any right issue, there is any further issue of capital, whether there is any bonus issue or any amount of partly paid up shares were there which are made fully paid up, or some more capital has been issued. Generally, this statement will have nil changes when the amount is fully paid up. Then explanatory notes attached to and forming part of any of the documents referred to in sub clause 1 to clause number 4. So balance sheet, profit and loss account, always the notes to accounts are always there. In relation to cash flow statement, there can be their equity of capital. So if there is any explanatory statement, that is also part of financial statement only. So unless you know the definition of the term, reading the provisions will not make you any smarter. So understand every word in law, then only you will have a command over the subject. And as a good company secretary, every word of law should be very, very clear to you. Every word should be very, very clear to you. And for the people who are there, just one suggestion that if you have not done your LLB, should do that. Should do that, because combination of LLB and CS, fantastic subject, fantastic combination. You will have 2 options of career, as a company secretary, as a lawyer. And if you have not done LLB, later on you will regret. So that chance should not arise. Take a note from my side. The strongest suggestion which I can make for your career, join LLB immediately. Anyway, forget which university is best. Degree is important, and how to read law that I am teaching you. Any degree, any university is okay. Any university, degree is more important as a LLB. Like today, I train number of lawyers. I have number of Supreme Court advocates who are my students, consistently studying law with me. But I cannot appear in the court. They have a right to appear. Right? So this is something very, very strange. So to equip you with that, I want you to have LLB degree. At the earliest possible, join that. The new sessions will be starting. Make it sure that you join LLB. Anyway, so financial statements. So financial statements shall give a true and fair view of the affairs of the company or companies, comply with the accounting standards. And those are in the format of Schedule 3. So 3 things are there in this part. Number 1, the financial statement should be giving the true and fair view of the statement of the state of affairs of the company. Those are prepared as per accounting standards which are laid down under section 133, and those are in the format of schedule number 3. Then exceptions are there: insurance companies, banking companies, electricity companies, companies created under any special law, and any company which are specified to the government. Those companies are not under obligation to prepare the financial statements in the format given under Schedule 3. They will be provided. So when the companies are created under a special law or for a specific purpose, which are covered herein under this section, then the format of financial statement is already prescribed under those laws. That's why this will not be applicable. And in general, the general rule of interpretation is that a special law will always prevail over general. So when a banking company is there, Banking Regulation Act, that is a special law that will prevail over company law. Same is about the insurance companies, same is about the banking, same is about the electricity companies. So when the special laws are there and a special law are having a format of preparing the financial statement, a special law will always prevail over general law. Okay. So provided further that nothing contained in this subsection, see here what is it? Nothing contained in this subsection shall apply to insurance, banking, or the company engaged in generation, supply of electricity, or such other class of company or form of financial statement has been specified under the act governing such class of company. So if there is a special law prevailing applicable to the company and the format of financial statement has been prescribed in that law, then that will prevail over the format given under Schedule 3. And the format given therein may not require so much of disclosures as are required in the Schedule 3. Those may require some additional entries, and that will not be considered as a violation of this, because in any case you are following the uh, uh, statement and given in some other law. So this section is altogether not applicable, and those who simply said nothing contained in this section shall apply. This is important, right? The type of companies we have already mentioned, which are the companies to which these provisions are not applicable. So nothing contained in this subsection shall apply to insurance, banking, electricity companies, as well as companies governed by a special law. Okay, so some of the things I'm not reading it out because now placing before the AGM. So when we discussed about the annual general meeting, so here it comes that every annual general meeting of the company, the board of directors shall lay before the such meeting financial statements for the financial year. So it is the responsibility of the board to place the annual accounts where when we discussed the annual general meeting, I explained you why it is called annual general meeting. Because earlier in the previous law, there was no definition of financial statement. We used to call them annual accounts. So the term of annual general meeting is directly related to annual accounts. So the general meeting of the company where annual accounts are placed or required to be placed, that is called annual general meeting. So same concept continues here also. So at every annual general meeting of a company, the board of directors shall lay before such meeting financial statement for the financial year. You cannot place financial statement in extraordinary general meeting. And if you do that, then that will, under any condition, those are not the financial statements approved in the AGM. So placing is required in the AGM, approval is required in the AGM. You cannot do that in extraordinary general meeting. Subsection 3 is saying about the consolidated financial statements. So where company is having a subsidiary as well as associate companies. It is one or more subsidiaries or associate companies. What is the meaning of associate company? First, tell me what is associate company? %20 share. Less than 20 or more than 20? 20 or more. If it is 70%, then what? Whether it is subsidiary or it is associate. Being a student of law is start being very, very specific. Very specific. One word can change everything. Right? Now I'll take you to the definition of associate company. So whatever I'm doing, I'm trying to teach you how to read law, because we may meet again, we may not meet, but you will at least understand how to read law. Right? Of course, I wish you to be in touch with me, but we never know. Okay. So how to read law, I'm taking you to again. Here comes the definition, associate company. In relation to another company means a company in which that other company has a significant influence, but which is not a subsidiary company. So when it becomes a subsidiary, when the shareholding exceeds 50%, so up to 50% will be covered here. And that includes a joint venture, right? Then it's defining it as significant influence means what? It means control of at least 20% of total voting power or control or participation in business decision under an agreement. So this is the long repercussion definition. It is not saying holding of 20%. It is saying control, right? It is talking about control. Now understand that it may hold those shares of 20% or 21% directly, then it is an associate. Then quite possible that the shares are controlled through the subsidiary. Then there will be two companies which are associated. Holding companies directly and subsidiary company also, both will be treated as associate companies of the third company. It is not referring only holding. It is talking about holding as well as control. So control is a much broader term. Got it? So every term you find, you can think that there may be a definition. Find that, refer the definition. Then only the things will become more clearer to you, right? So where a company has one or more subsidiary or associate companies, it shall in addition to financial statement. So this is some additional, right? So CFS is not a part of financial statements. We have read the definition. So there we talked about the balance sheet, the profit and loss account, the cash flow statement, plus a statement of changes in financial position. So consolidated financial statement is not a part of financial statements as per definition. So that's why it is saying in addition to financial statement. Had it been a part of the definition of financial statement, then this subsection itself was not required, right? So that's why consolidated financial statement is not a part of financial statements as per section 2 subsection 40. That's why this is in addition to financial statement provided in the subsection 2. Prepare a consolidated financial statement. I'm reading there. So prepare a consolidated financial statement of company and all of the subsidiaries and associate in the same form and manner as of its own. What is consolidated financial statement? That is something big subject. In accounting, you must have done consolidated financial statement. Company accounts, haven't you done? It means CF finally it is there, but in company account, you must have also done it. I think this is not the time for me to explain consolidated financial statement, but I suggest strongly you read that thing. That is very, very important, very relevant and useful. Right. So right now I cannot go into the discussion. Okay. So where a company is having one or more subsidiary associate company, then it is required to prepare a consolidated financial statement, and that is in addition to the financial statements which are defined under section 2 subsection 40 and all statutory provisions applicable to financial statement apply to consolidated financial statement also. It means accounting standard required here also, true and fair view required here also, placement before the AGM required here also. So whatever is applicable to financial statement, that is applicable to consolidated financial statements also. So here where a company has one or more subsidiary or associate companies, it shall in addition to financial statement provided under subsection 2 prepare a consolidated financial statement of the company and of all the subsidiary associate in the such form and manner as that of its own and in accordance with the applicable accounting standard, which shall also be laid before the annual general meeting along with the laying of the financial statement of subsection 2. So a lot of duplication in this process. Simply, they could have said that all the provisions applicable to financial statements are equally applicable to consolidated financial statement also. Matter ends. It means accounting standard required, true and fair view required, placing before the AGM is required, filing is required. Automatically everything becomes applicable. Why to explain it again and again? Okay, rather this creates more confusion. Now this further says, provided the company shall also attach along with the financial statement a separate statement containing the salient features of the financial statement of the subsidiary and the subsidiary associated companies in such form as being prescribed. So this is not CFS. This is something other than that. Okay. And here, subsection 4 says provisions of the act applicable to preparation, adoption, audit of the financial statement of a holding company also mutus mutandis applied to consolidated financial statement referred in subsection 3. Now, again duplication. They've already referred something about, and again here they've repeated here. This is a much better line rather than whatever you have studied in the previous subsection. Then whatever is applicable to financial statement, that is equally applicable to consolidated financial statements also. Okay, subsection 5. This is something on which you can find questions in the exam repeatedly. Disclosure of non-compliance with the accounting standard. So requirement of the compliance with the accounting standard, that is in subsection 1. So where company has not complied with the accounting standard for any reason, whatever be the reason, that is not the question, but for any reason, then first of all, a statement has to be made in the financial statement itself that company has not complied with the accounting standard. Which accounting standard? Why not complied with? What is the impact of that? Everything should be disclosed. So compliance with the accounting standard, that is a statutory obligation under subsection 1, and failure to comply with the accounting standard has to be disclosed. How much disclosure? First is failure to comply with the accounting disclosure. Number 2, which accounting standard? Number 3, why? Number 4, what is the impact of non-compliance? Everything should be disclosed therein. So number 5, subsection 5 says, without prejudice to subsection 1, when the financial statement of company do not comply with the accounting standards referred to in subsection 1, the company shall disclose in its financial statement the deviation from the accounting standard, the reason for the deviation, and the financial effect, if any, arising out of such deviation. 4 things. Number 1, deviation is there. Deviation and non-compliance is one and same thing. Number 2, which accounting standard? Number 3, why? Number 4, impact. Okay. Had you complied with those accounting standards, how the financial statement would have changed? Give a reason, give us a statement for that also. That is subsection 5. Okay. Then subsection 6 is giving the authority to the government to allow exemptions. So this is the government may on its own or on application of the class of companies by notification exempt any class or classes of companies from complying with any of the requirement of the section of the rules or made thereunder. It is considered necessary to grant exemption in the public interest, and such exemption may be granted either unconditionally or subject to such conditions as may be specified in the notification. So this is again an exception to subsection 1, because subsection 1 is saying that the account shall be prepared in the format given in the schedule 3. And if it is compulsory, and there may be certain information which are not desired to be opened to public, then subsection 6 becomes relevant. This says, read it again with me. The central government may, on its own or on application by class of classes of companies. So either on its own or an application. By notification. So this is not a specific order. This is by notification. Exempt class or classes of companies. So exemption cannot be claimed by one company in a specific unless that company itself constitutes a separate class. So one company will constitute a separate class when there is no other company engaged in the same activity. Right. In that case, one company itself can be a class. Otherwise, this exemption is for the class of companies. Wherever it is considered necessary to grant such exemption in the public interest, or such exemption may be granted conditionally or unconditionally as the case may be. So exemptions may be given by government on its own or on the basis of application. Right. Now I'll give you an example for this also so that it becomes clear. I was working for a company which was in the manufacture of steel tubes. Steel tubes. And the diameter of steel tubes manufactured by company started with the range with the minimum of 6 millimeters up to this size, going up to 50 centimeters. Huge one, right? From 6 millimeter means half centimeter, or the 5 mm, half centimeter to 50 centimeters. That was the diameter of the steel tubes made by the company. And one of the requirement of the old financial statement was to give a disclosure of the quantity produced during the year. So quantity was only in terms of meters. Quantity was in terms of meters. Now, if I mention there is the company has produced 5 lakh meters of the steel tube during the year, it is 100% confusing. Which diameter, which tube has been produced more, which is less? Because there's so much of wide range, starting from 5 mm going up to 50 mm. We made a request to the department, giving them explanation that why this is confusing. Rather, this will create more confusion to the people, those who are analyzing the balance sheet. How much quantity of steel is required for producing 1 meter? Because there may be some other competitor who is also manufacturing steel tubes, and his production may be only from 5 mm to 20 mm, and our production is 5 mm to 50 mm. There will be a lot of conflict, lot of confusion in the industry. Better give us a chance to exclude this information, right? So we used to give only the information that this much of quantity of steel has been used for production of the steel tubes, but how much quantity is produced, that was never mentioned. Okay, so earlier there was a provision where exemptions could be taken by a specific company as well, but now that does not exist. As of now, exemption is available to the class of companies. Subsection 7 is about the penalty, and just forget this. Section 130, reopening of the accounts of the court or tribunal's order. So there are two ways where the accounts can be reopened, either under section 130 as well as under section 131. Both are different. Under section 130, it is only when a direction is given by the court or tribunal, and under section 130, either central government can apply, or SEBI can apply, or the income tax department can apply, or some other government entity can apply to the tribunal or the court. And when the order is made by the court or tribunal, only then the books can be opened. Under section 131, the board has been given a right to open the books of account on its own. But the difference is, under section 130, the books of account can be opened up to last 8 years. And if the books are required to be preserved for a period longer than 8 years, then for any period that is under section 130. Under section 131, the accounts can be re-prepared only for preceding 3 years. That is the major difference. In any case, both sections are really not comparable, because here under section 130, the recast of the accounts is required, or reopening of the accounts can be done only if an application is made either by central government or SEBI or income tax authority or some other statutory body to the court or tribunal, as the case may be. And in that case, order can be passed for reopening of the accounts of any of the preceding 8 years. And if the books are kept for more than 8 years, then it can be longer as well. But under section 131, that is done by the board of directors on its own under a special condition with the permission of the tribunal, only in relation to any of the preceding 3 financial years. Right. So that is the difference. So before we go into the details, first of all, I gave you the difference, and now we will read what is in section 130. So section 130 says a company shall not reopen its books of account and not recast its financial statement unless an application in this regard is made by central government, income tax authorities. Slow down. Today I'm only up to 10:30. Time is less. I want to cover up. So a company shall not reopen its books of account and not recast the financial statements unless an application in this regard is made by the central government, income tax authorities, SEBI, and other statutory regulatory body or authority or a person concerned, and an order is made by the court or competent jurisdiction or the tribunal to that effect. So under this section, the board of directors cannot do that. Application to the court or tribunal. Why? If the relevant earlier accounts were prepared with a fraudulent manner, or the affairs of the company were mismanaged during the relevant period, casting a doubt on the reliability of financial statements. So these grounds are more important. On what grounds application can be made under section 130 for recasting of the financial estate? So number one, so those are prepared fraudulently or the affairs was mismanaged, therefore accuracy of the financial statements during that period is a doubtful. Okay, then provided that the court or tribunal, as the case may be, they will not pass an order directly when an application is made. All other related parties will be given a notice, everybody will be given an opportunity of being heard, and then only any such order can be passed. So under this section, just remember this one, that what are the grounds? And subsection 3. No order shall be made under subsection 1 in respect of reopening books of account relating to period earlier than 8 financial year immediately preceding. This is the period for which recast can be ordered. And provided that where a direction has been issued by central government under subsection 128, subsection 5 for keeping the books of account for a period longer period, then books may be ordered to be reopened for a period longer than. So prima facie, any books of account which are required to be preserved. So preservation period is already given under section 128 subsection 5. So books of account can be opened for that period, and then if required by the government to keep the books of account for a longer period of time, then those can also be ordered to be reopened. So that is section 130. Is it understood or something more is required in that? Come quick, don't have much time. Thank you, friends. So when you give me a feedback, that is really, really exciting, and I feel more enthused, more energetic to do more, but by chance, we have limited time. Okay. Thank you for the feedback, and by the time I end the session today, I will request you to send me a feedback either here on the group or either here itself in the chat or in the group. So the class is no more on this platform because this is the last class allotted to me. Okay. If the reopening of the balance sheet more than 8 years at the same time, the company doesn't have the record. No, you see, it is already mentioned therein that if the government has given an order for keeping the books of account for more than 8 years, only then this can be done. You see, it is already mentioned in subsection 3 that is open. Okay. So this is where, provided that where a direction has been issued by the central government under provision of subsection 5 for keeping the books of period longer than 8 years, the books of account may be ordered for period within such a longer period. Beyond 8 years, it is order can be given only if the books of account are kept otherwise. So those who have not joined my group, join now, join today. Then we can take up, then we can do something more. Okay. Now here comes voluntary revision of financial statements. So this is voluntary. So I give you the difference in section 130, that is only by the on the basis of application made by either central government or SEBI or income tax or some statutory authority. Here it is a voluntary revision of financial statements or board report. Now see, it is something different. Under section 130, the board's report is not covered therein. This is what is said: reopening of accounts, reopen of books of account, recast financial statements. So this does not cover board's report. Another difference. Number, I have written number of times. Once again, I'm writing my number to send a request here. And this is the last time I'm posting my number here. No more posting of my number afterwards. Okay, so the difference comes here. So once you start studying in comparison, then becomes much easier to remember that. Right. Even if you miss the section number, but you certainly remember the difference, that in that section that was the case, in this case this is that. So here under section 131, voluntary revision of the financial statements of the board's report. So in addition to financial statement, board report is also covered herein. Okay, so this says where it appears to the directors of the company that financial statement of the company or the report of board of directors do not comply with the provision section 129 or 134. 134 the contains an authentication, approval and authentication of the financial statement. They may prepare, revise financial statement or a revised report in respect of any of the three preceding financials after obtaining approval of the tribunal. Now, this is another point of difference. Under section 130, the court or tribunal may order for reopening of the books of account or financial statement for any of the preceding 8 financial years, or even a period longer than that if the books of account are kept with the company for longer period. But here it is only 3 preceding financial years. With the prior approval of tribunal, the court is not here. Only tribunal. On an application made by the company. So who is making the application? The application is being made by the company. So company means every action by the company is taken, every action on behalf of the company is taken up by the board of directors. So whenever you say by the company, it means the action is to be taken by the board of directors. The application is made, provided that tribunal shall give notice to the central government, income tax authority, etc., etc. So again, that will remain, that will follow the same. Provided further that such revised financial statement report shall not be prepared or filed more than once in a financial year. Forget this, nobody prepares revised accounts. So this portion you can read out. The main important difference I have discussed, section 132, that is constitution of NINFRA, that is NFRA, National Financial Reporting Authority. So this is 100% portion which you can, if you have time, read, but otherwise you can simply omit. Nobody will ask you any question out of this section. Accounting standard, this is also the something same, so forget this also. Yes, now we come to an important section, that is section 134, financial statements, board's report, etc. So actually in this section we are not talking about financial statement, we are talking about the board's report. So this says the financial statements, including the consolidated financial statement, if any, shall be approved by the board of directors before they are signed on behalf of the board. Not important for the purpose of examination. The constitution of that body, it is not relevant for the purpose of exam. You have nothing to comply with. So wherever there is a compliance as a company secretary, there is a question. When there is nothing to comply, there is no question for you. Okay. So financial statements plus the board's report have to be approved with the board, and then after the approval only those are signed. Right? So when you prepare the documents in relation to board meeting, particularly agenda for the board meeting, right? You simply write to place financial statements to consider, adopt and sign, sequence, place, consider, approve and sign. Okay, sequencing should not change, because if you change the sequence means you don't understand the law. So yeah, the financial statements, including consolidated financial statements, if any, shall be approved with the board of directors before they are signed on behalf of the board. So board doesn't sign. Board is a group of people. It is always signed on behalf of the board. Then who can sign? This can be signed by the chairperson of the company, if so authorized by the board, or by the 2 directors. So again authorized by the board, but one of the 2 directors should be the managing director, if any, plus. Right. So choice is chairman or 2 directors. This is minimum. More directors signing, always welcome. Minimum requirement is Chairman alone can sign if so authorized by the board. If not so authorized, the board can authorize two directors. One of them should be managing director. If not that, more director want to sign, more always welcome. Nobody is prohibiting. In addition to directors who should sign, there should be chief executive officer, chief financial officer, company secretary, if any. Not necessary CEOs everywhere. Not necessary CFOs everywhere. Not necessary company secretaries there. But if they are appointed, then they are also required to sign. If they are not there in the company, that is not compulsory. So minimum signing by the directors. Right. In addition to directors who should sign, CEO, CFO, CS. So everywhere 3 C's they should also sign. CEO, CS and CFO, they should also sign, but if they are in the company. If they are not, then the question of signing does not arise. Okay. Then subsection 2 says the auditor's report shall be attached. The meaning of annexure and attach we discussed, I think, in the first or second lecture. What is the difference between attach and annex? So this is attached. So this is not the part of financial statement. So anything wrong in the auditor's report, the auditors are not responsible, and anything wrong in the financial statement, auditor is not responsible. Right? Because auditor simply, the auditor's report says, as per information given to me, this is our audit report. So tomorrow, if you find something wrong, and if I gain the wrong information, I'm not responsible. So that's why auditor's report itself is a separate document, and that's why it is attached. That this is, there shall be attached to the statement laid before company in general meeting, a report of the board of directors shall include. Now, board of directors report is also attached. That is not the part of financial statements. This is also attached, which shall include. Now here we have a long list of what should be there in the director's report, and as a company secretary you should know what is required in the director's report, and I will strongly recommend to draft a director's report as required here. That is your homework today. Write the director's report, draft the director's report, and cover maximum points required to be covered. You can make a summary report as well, but not summary. Cover point required to be covered by law. What is required to be there in? Number A, the web address, if any, their annual return referred to in subsection 3 has been placed. The number of meetings of the board, director's responsibility statement. What is called director's responsibility statement? This is an important question. This is a very, very important question. And this I have seen number of times in the exam. What is director's responsibility statement? Accounting standards have been followed. Internal control. What is the director's responsibility statement? Keep on answering, keep on answering. I'm having a look at it. Keep on writing. This is answered in subsection 5 here. In the same section, subsection 5. The director's responsibility statement referred to in clause C. Clause C you can see on the upper side of subsection 3 shall state that. So shall state is there, right? That is compulsion, that it should be there. See the sequence. Here the sequencing is not correct. What sequence should be? That I'll tell you later on. Number A, in the preparation of annual account, the applicable accounting standards had been followed. First is compliance with the accounting standard. Director have selected the correct accounting policies. The directors had taken the proper and sufficient care for maintenance of adequate accounting records. Then directors had prepared annual accounts as a going concern basis. The directors in the case of a listed company have laid internal financial controls, and those are being followed. These 5 things together are called a director's responsibility statement. Number of times this question has been asked, what is the director's responsibility statement? Right. So this is, as far as AS is concerned, simply one is a statement that AS are followed or not. If you make a statement this is not followed, then you have to give it much more information about that, and that we have already seen before. What more information is required to be given? Okay. So this is a long list of contents which are required to be given in the director's report, and I have given you homework. Prepare a detailed director's report covering every point which is listed. Okay. So since time is less, we cannot discuss the whole story. We are moving a little fast. Number 4, this is the report of board of directors to be attached to the financial statement. So this is also attached. Auditor's report is attached, director's report is attached, because this is not a part of financial statement. So financial statements are required to be placed in the AGM, and when these are required to be attached, then these are automatically placed before the AGM. Then this is, we discussed what is responsibility statement and who will sign the director's report. The board's report and the annexure thereto under subsection 1 shall be signed by chairperson of the company if so authorized by the board, otherwise any 2 directors who are authorized by the board, including 1 MD. So same who are required to sign the financial statement, the same people are required to authenticate the director's report also. So board can authorize only the chairperson, board can authorize 2 directors, and if there are 2 directors, then they are also required to sign. One of them should be managing director. The difference in authentication of the director's report and the financial statement, the financial statements are also required to be signed by CEO, CFO, CS. Director's report only directors, nobody else. Number 7. A signed copy of every financial statement, including CFS, shall be issued, circulated, published along with notes, auditor's report, and board's report. So even if these are not given, you will understand, because in the definition of financial statement, we have said notes, and notes are part of the, so whatever explanations are given to the information given under the balance sheet, profit and loss account, consolidated cash flow statement, and a statement of changes of financial position. Those are part of financial statement. That is point number A here. Any notes annexed to their financial statement, right? Then auditor's report, that is attached. Director's report, that is attached. So this is the duplication actually. This entire subsection is the duplication, because earlier we have already said that these notes, explanations, these are part of financial statement. Auditor's report shall be attached with the financial statement. Board's report shall be attached with the financial statement. So wherever the financial statements are, these documents will always be there together. Right. So this subsection 7 seems to be little duplication, but for you that is a piece of information. Then comes penalties. Corporate social responsibility. This is one again important area on which question you will always find in the exam. What is corporate social responsibility? So this is that every company and the current situation, this pandemic situation, CSR is becoming more and more important, and all the companies are requested to contribute toward the same. And the activities which are covered in for helping the CSR, this pandemic situation, those have been amended and brought under CSR. Earlier, those were not there. So every company having net worth of rupees 500 crores or a turnover of rupees 1,000 crores or a net profit of rupees 5 crores or more during the immediately preceding financial. So when the provisions become applicable, when any of the requirements is fulfilled. The requirement is it is having net worth of 500 crores or turnover of 1,000 crore or a net profit of rupees 5 crores in the immediately concluded financial year, then provisions become applicable and the company is required to contribute toward the CSR, and this is the decision has to be taken, and the company will have to constitute a CSR committee for that. What is the role of CSR committee? CSR committee will decide exactly the amount of which is to be contributed for the CSR purpose, where to contribute, what are the activities to be done, how the supervision will be done, and how the reporting will be done for that. So that is the role of CSR committee. So CSR committee is not the part here. So right now I'm just explaining what is CSR committee. So one of the committee where, first of all, where the provisions are applicable, the company should constitute a CSR committee. What is the role of committee? The committee will determine how much amount should go for CSR activities as per legal requirement. Number two, what are the activities which should be done under the CSR activities? Whether company should be doing alone or with somebody else? What is the supervision mechanism? How the track will be kept for the amount spent on that? Everything will be done by the CSR committee. The CSR committee can make the recommendation to the board, but the board is not bound by that. So as far as the foreign companies are concerned, the foreign companies are responsible only to the extent of their business in India. So if their business in India fulfill under these requirements given herein, then provisions are applicable to them also, but only for the profit earned in India. Right? So foreign companies are also under CSR, but only to the extent of their business operations in India if these requirements are met. Some questions are there on the chat. Let me check it and say immediately preceding financial year, but sir, before it is any of the three preceding financial years. No, so provisions continue to be applicable as long as any of the three requirements are applicable during preceding three financial. So that is the requirement when the provision cease to be applicable. So as long as any of the requirements are fulfilled during preceding three financial year, provisions will continue to be applicable. It means if nothing is applicable for the three financial years, then provisions will no more be applicable. So that preceding three financial years is not for applicability, that is for non-applicability, when the provisions will cease to be applicable. So if any of these requirements are met during the preceding financial year, then provisions will become applicable. And once applicable, those will be applicable for at least 3 years. Because as long as any of the three requirements are met for 3 years, provisions will be applicable. And when it is proved that nothing of this is applicable for 3 consecutive financial, none of the requirements are applicable, then provisions cease to be applicable. Now, the board of directors shall disclose the constitution. The CSR committee shall formulate. So what is the role of CSR committee that is given in subsection 3? The board of every committee referred to in subsection 1. Then board is not bound by the recommendations made by the committee. And the board, subsection 5, I'm reading, the board of every company referred to in subsection 1 shall ensure that the company spends in every financial year at least 2% of the average net profit of the company made during immediately preceding 3 financial years. So if 3 financial years are not there, whatever amount is, whatever net profit is available in 1 year or 2 years or 3 years, then divide that by 3, and that is the amount available for CSR activity. So time is running out. Okay, so Schedule 7 is the list of activities which are covered, which are defined as activities for CSR. And here, some amendments have been made recently. With effect on 20th June, some amendments have been made. And I will show you the amendment made. This amendment, just measures for the benefit of the armed forces, veterans, war widows, and their dependents. Then further added Central Armed Forces CRPF and the Central Paramilitary Forces veterans and their dependents, including widows. This has been added recently. What is shown in number 8, that has been added very recently, and some more amendments. This is also recent amendment number 7. Number 7 says Prime Minister Citizen Assistance Relief in the Emergency Situation PM Care Fund. The PM Care Fund is other than Prime Minister Relief Fund. So that is a separate fund that has been added herein so that companies can contribute, and the contribution will be taken as a CSR activity. So friends, now this is the list of the activities, and this is not an exhaustive list. The best part is that this is not an exhaustive list of the activities which are to be treated as CSR activity. If you read the title, they say activities which may be included by companies. So this is not the exhaustive list of the activities to be considered as CSR activities. So either any of these or any activity which is relating to these will be treated as a CSR activity. Only thing which is to be kept in mind that the activity should not be directly related to the company's own business, and the activity should not be mainly for the benefit of the employees. If two parameters are met, any activity for social advantage for the public benefit will be treated as a CSR activity. Most important things. Number one, not related to the business of company directly. Number two, those are not mainly for the benefit of employees. And CSR activity preferably within the periphery where the company's office or the factory is situated. But any activity in relation to CSR done outside India will not be considered in, will not be taken into account for this purpose. Okay, so this is about CSR, and friends, by chance today I have to close by 10:30, so only 7 minutes are left. So let me see. Right of the members to get the copies for this is not this you can read. Thank you, Tatiksha. And this you can read. What I will suggest you to. Yes, today is the last class. Copy the financial statement to be filed with CSR. This is you. This you have to understand that if the annual general meeting is held, then you have to file financial statements as placed before the AGM, whether adopted or not, within 30 days after the date of AGM. If AGM is not held, then you are required to file audited. Underline the word audited. Okay, along with director's report, auditor's report, along with the reason why it is not, why the AGM has not been held, and when AGM is held, then you can file it again. And when it is placed, when the financial statements are placed in the AGM, and for some reason if those are not adopted, then still you have to file unadopted, giving the reason for non-adoption, and later on when those are adopted, you have to file adopted ones. So this is section 138, and I think this is the end. 138 is the last section, that is about the internal audit, so that I'm not going to discuss in detail. And then the next chapter about the audit. So friends, here is the time to say goodbye. So we have another 5 minutes. If you have any comments to make, those comments are welcome. Thank you, Prafula. Thank you, everybody. Thank you, Aswati. Thank you, friends. How to read law? This is what I've been doing since last 7 lectures. How to write in the exam. So be in touch with me regularly and consistently. I keep on informing what is to be done, how to learn the things, how to be a super learner. That is also very, very important. How to be a super learner. So for being the super learner, the first thing required is you must know how to read fast. Number two, how to focus more. Number three, how to concentrate. Then how to memorize. These are few things which are required to be a super learner. No, Renu, this is not the request that I can make. So be in touch with me. We will be doing a lot more things. And day-to-day basis, I'll keep on sending you some of my motivational messages. Every day I write something, so I'll keep sharing with you. And if you need my help, I will be there to help you. Right? So once again, I'm requesting you. Do you see? Once again, let me revise how to study. Okay. As of now, time is less, but those who are preparing for December, in one day, don't try to cover up more. take a lot of 25 to 30 pages, read those 5 to 6 times, then prepare notes. No noting, no highlighting, no pitch, anything during reading. Read 5 to 6 times. When concept is clear, make the notes in your notebook. Then compare with the material that nothing important is left out in your notes, and then revise from the notes only. And the length of notes should not be more than 20% of the material that you are reading. So if you are reading 25 pages, your notes should not be more than 5 pages. So the revision becomes very, very fast. And since you are making the notes after 5 or 6 readings, notes will be very, very crisp and fine. Okay. There are a lot of many things we can talk about how to study, and that is what the program is, which is called Super Learner. Become a super learner. My best wishes are with you. And by chance, what is your expectation? If I'm not able to complete, that is because of lack of time. I wanted to do a lot more, but since time is less, so today I have to wind up. Thank you very much for being with me, and bless me. Pray God to bless me. Thank you. Thank you, everyone. And here I'm. No, I have done enough. Not much of the time is available. Talk on the group. So anything more? So friends, time to say goodbye and be in touch with me. My best wishes, my blessings will always remain with you. Namaskar.